Good day and welcome to the Korner Perspective local portfolio commentary for the 6 months to 30th of June. Because this video is so late, we're going to update the data to the 20th of August. So just starting out with the some of the context of the JSE performance. If you look over a 1-year view, very much a gold and technology story. If you look 3 years, very much a technology story, and 5 years, very much financials, particularly the banks because of the base effects, but also telecoms. We had actually quite an active 6 to 9 months relative to our typical style. Some of our common acquisitions purchases included Valterra, that's quite recent, along with Anglo American, Quilter, Coronation, 91, Bondi, and African Rainbow Capital. Some of those, like Quilter, very much concentrated in the fund, as was Bondi. And then looking at some of the more common sales, obviously the delisting of the Absa Pref, but then also selling out of the last of the Discovery that we held, reducing African Rainbow Capital, and then selling out of some British American Tobacco, particularly in the fund. We also received via corporate actions over the last year or so, Brait, and obviously Valterra, that was previously known as Anglo Platinum. And then we trimmed holdings, for example, in Naspers, Reinet, and Shoprite. I'm going to spend a little bit of time on some of the bigger holdings. That's Naspers, the big banks, and Ethos, for example, because they are significant holdings, and they very much sort of set the tone for the performance of the portfolios. So starting out with Naspers, you can see, from the beginning of this year, from around 4,000 Rand a share to almost 6, been a great performer, driven in large part by Tencent. You can see top left, Tencent feeds into Prosus, which feeds into Naspers. So interestingly, Prosus themselves have actually become a lot more active. We see them as sort of getting back a little more to their sort of VC roots. You can see significant investments in M&A, but also quite a big investment into AI, but then also rationalizing the portfolio and unlocking some value, for example, with IPOs in Swiggy. Looking at the Naspers, that all translates into a net asset value of almost 10,000 Rand a share. Obviously, there's some tax liability there, which would weigh, but clearly from around 5,800 Rand to almost 10,000 Rand, a very nice discount into net asset value. Tencent is really the engine room for Prosus and Naspers, and it often probably doesn't get enough attention. What I've got there with all those icons or logos is really just a little bit of a history from, QQ, which is almost going right back to the original Tencent, almost as a messaging and ISP kind of business, through to some of their more recent acquisitions, for example, culminating in Universal Music Group. So one forgets, one of the world's biggest companies, just how much M&A and investment in startups has actually happened in this business over the last 20 odd years. And you can see that Tencent has been active. It continues to evolve. Massive investment, as we indicated, into AI, but it's grown up. You can see there, bottom left, in 2024 they repurchased 307 million shares for 112 billion Hong Kong dollars worth of value. The proof very much in the pudding. So all this effort, all this investment into subsidiaries and startups and associates, very much translating into them moving the needle from a financial point of view. You can see FY24 revenue was up 8%, and interestingly also just to look between value-added marketing, fintech, for example, how much more balanced this business is than it was a few years ago. So 8% revenue growth translated into 19% GP improvement, translated into 24% operating profit, and net attributable to equity holders, a very impressive 41%. So very much the pudding is being delivered. You can see the margins there on the right-hand graph, everything from the gross through value-added marketing, etc. Very, very nice improvement in gross margins. Right, so that frames the performance of Tencent and why we believe Naspers and Prosus are running. The other big holdings, Standard Bank and Absa, for example. If you look at Standard Bank, it's done very nicely over a 5-year view. If you, however, look a little bit further out, maybe been a little bit more disappointing, and we're not entirely sure why that is. If you look at the 10-year earnings growth, you're getting CAGR of about 8%, which translates into real growth probably of around 3.5%, maybe 4%, which is very decent in considering the lousy South African economy and the impact of COVID. So decent, solid trend line, and you can see how they tend to sort of deliver EPS around the trend. For us, the big investment case right now is that Standard Bank is trading on what we believe to be a massive discount to PE. Historically, what we've illustrated in this chart, the blue line is the PE, historic PE over time, and the orange line is the average. And you can see that the 20-year average PE is a touch under 11 times, being 10.9 times. And you can see the current multiple, of 8 and a bit is really a massive discount to that long run PE. Often the accounting conventions cause very, big swings in earnings. What we just wanted to illustrate with this chart is the blue line is the actual earnings that are delivered. The orange line is the 3-year rolling. So we basically just add the 3 years together and divide by 3 to give you a slightly more smooth earnings picture. And you can see just again how well it tracks it. And I think for us the clear picture here is that the EPS very much follows the trend. Also, if you look at it over time, taking the theoretical price, so if we took those rolling 3-year earnings, applied a 10.9 multiple to them, and then we actually illustrated the actual prices at each year end, you can see currently, with a current share price of just under 250 Rand, trading at a very significant discount to what would be an implied value of around 300 Rand a share. So that's very much the reason for the overweight position. Absa, quite a similar story, but here maybe not performing quite as well. If you look from the beginning of 2022, Absa's basically just trended sideways. And the question then is, have they delivered such poor results that is warranted? What we try to illustrate here with their earnings and dividends over time is that it's very much a tale of two halves. The first half of this decade was very tough, earnings basically not growing. But since 2021, a combination of factors have really seen the earnings growth restoring, and you're now back at a business that's very much delivering solid earnings growth, and obviously dividends just flowing through because of the strong cap-add ratio. I don't want to dwell too much on Absa's fundamentals, but you can see they're a very, very nicely balanced business. Interesting how CIB has grown in their relative world along with the African operations. Cost increases around 6% on average, with the spend tilted towards what we would call good spend, technology and staff, for example. Credit loss ratio definitely helped to drive the half-year results. So these are the June numbers. You can see the credit loss ratio back at 100 basis points, which is the upper end of the board's guidance of between 75 basis points and 100 basis points. But you can see from the first half 24, a very nice improvement from 123 basis points. So that obviously helping to drive the earnings forward. Top right, you can see the photo of Kenny Fiedler, who's the new CEO. We really are encouraged by his appointment. It's a loss for Standard Bank, but we believe that Absa has got a good franchise. It's a very well-placed business, and with good leadership and synchronicity in the board, we think this business will do very well. So the question then is, how much upside is there in Standard Bank and Absa if we've got such big holdings in it? These are very busy slides. I think if I can draw your attention to the left-hand side, in that top block, you'll see we're talking about earnings per share for the December year, which is still got to happen to December 25, of almost 30 Rand a share. If you applied a 10.5 multiple, which is a slight discount to the long run average, you still get 25% upside. If you look to 26, you're getting 36% upside. And interestingly, you're being compensated, as you can see, with a dividend yield of over 6% if you ignore DWT. And if you bring DWT in, you're still getting over 5%. So comfortably beating cash. ABSA, even more compelling if you look at the forecast for 2025, just under 30 rands worth of earnings, so similar earnings likely. We're going to put that on a 10 multiple. Their long run average is closer to 10. That gives you upside of almost 60%, and miraculously, given strong earnings forecast for 2026 out of ABSA, massive 74% upside. And as you can see, if you look at the 2025 forecast, dividend yield excluding DWT of 8.7%. So you're being very, very handsomely compensated for your patience while you wait for the market to apply the sensible ratings to these companies. Then Ethos Capital, obviously it's done really well. So if you go back to the beginning of 2024, when it was around 4 Rand a share, a lot's happened. Value has been unlocked. Top right, we're illustrating, what Brait has done since it was unbundled, and obviously shareholders would have followed their rights at that very low level. That's been a massive value creator. But then you can see also good progress elsewhere in the portfolio. NAV at around 8 Rand a share at December half year, still at a very, very sizable discount to NAV. Also, more NAV unlocks are going to come. You can see bottom tab, bottom graph there. Short term, not very much, but on the medium term, some significant unlocks expected from transactions expected in Vertees, Optasia, etc. And then longer term, we see in the bulk of this portfolio, around 2/3 of it, significant upside in assets like Time and Optasia. Obviously, MTN is already unlocked. So a lot going on in this slide. I think the key thing for us is Optasia is looking to do a listing, and we really hope that is a precursor to Ethos actually unbundling the holding in Optasia rather than them selling it at some discounted level. So we remain constructive. We believe that the NAV unlock is very much on track, and there's a lot more value to be extracted from Ethos. BHP, don't want to dwell on it too much, been disappointing from when they did the PLC to Australian listing conversion, basically gone nowhere. Obviously, the earnings, courtesy of the COVID high in earnings, make it look a lot worse, but you're still looking at a sub 10 PE, very strong dividend yield, great quality portfolio. It's just right now, obviously, the cycle's slightly against them, but very much still our preferred through the cycle commodity play. ShopRite, we've indicated this before. We love the business, but we didn't like the price. You can see from over 300 Rand a share, it's just been sort of drifting downwards all through 2025. And as we keep saying, there's nothing wrong with the company. It's just the market that's got it wrong. You can see there, nice trend line in earnings, although not spectacular, actually quite similar earnings growth to what we've probably seen on average in CAGR out of ABSA. But nice strong trend, expecting a bit of an acceleration in 25-26, particularly with that low 24 base. But as you can see there, the problem with this, if you ignore the 25 forecast, because that's really June, which is already passed. If you look to 26, earnings expected of around 15 Rand a share, representing around 8% earnings growth. And for that, you're paying a very significant almost 18 forward PE. The dividend yield is edged up, but it's still not, we believe, good enough. So we believe that explains the underperformance in ShopRite, and also explains our decision to effectively exit ShopRite completely for the fund. Reinet Investments worked very well. We'll remind you that it was in large part our preferred play in British American Tobacco. BATS have now been completely sold, and Pension Insurance Corporation is effectively being sold, which will leave this with effectively cash NAV. The question is what the family will do. We believe there's an incentive for them to retain it apart from the fees, but clearly it would be trading at a discount to cash at the moment. So we'll see what the next chapter holds, but for now we're going to run it, also in the hope that we may see some value unlocked through specials, which obviously you want to be a participant in. Remgro's done very nicely from when we sort of got excited about it ahead of the first Rand value unlock. It's done well, we think, with the delisting of Mediclinic and Distel / Heineken. The market's battling to get its arms around it. Our best guess is it'll drift sideways, but there's some great assets in there, and we always say you're in great company. Argent Industrial, we've said it before, it was very much like the poster child of value investing and a case for small caps and how patience can be rewarded. From 4 Rand to almost 28 Rand, it's been a great performer. We believe there's still a lot of value in this one, and there's a high probability this business won't be listed 2 years from now. TFG, the share price is a hell of a lot more disappointing in our view than the operational result. The recent results, some acquisitions maybe flattered the numbers a little bit, but we still believe this is a very, very well run, very well put together business that really is almost best in class. And anything closer to 100 Rand will definitely be adding to this one. We did sell a little bit when it sort of rallied hard in the fund, so that our position now is actually fairly modest. We still like this business. It's just a question of leaning more towards buying right now than being a seller. Process, we've discussed at length on Naspers. Aspen really has been the standout disappointment. From when we first got into this business and keep buying drinking the Kool-Aid, very disappointing with the dispute, massive impairments, the guidance, and we'll get results very soon. Guidance is not painting a pretty picture, and our sense is we'll have to take our medicine at a point in time, but we're really just waiting for clarity on what the nature of those disputes and those impairments are. But unfortunately, we have to say that Aspen, there's just too much complexity in this business. There's always the promise and the optionality around GLP-1 and so forth, but the reality is management have been disappointing for a long time, and there's probably just too much complexity in this business. Brait, the 5-year chart is kind of irrelevant to us. It's really from middle of last year when it was unbundled out of Ethos. Done very nicely, as we indicated, from around 80 cents to over 2 Rand. Been a good performer, and the underlying portfolio there is still solid, very much a Virgin Active driven NAV though. City Lodge, it's just one of those that the market doesn't seem to like. I think they're delivering a good job. I think they're not reasonably, I believe they're well run. Valuation is very undemanding. Seeing more and more how they're being used for foreign tourism. But yeah, I think the bottom line is they're going to have to rebuild the reputation after the pain of COVID. York Timber, similar sort of story. We're waiting for that new model where trees are harvested later. That should start quite soon, and that we believe will really light a fire under this share. CUP has been, along with Aspen, very disappointing. I think the difference here is that we still believe that the core business, the PG Bison, the plastics business, etc., are all good businesses. We think it's probably just a little bit of technicality that's weighing on the reason for the guidance. And in fact, we are going to get results out of this one tomorrow. We've already seen it recover quite significantly. We still believe this is a great quality asset, and we look forward to the new management in the form of Frans Olivier taking this business forward. Valterra Platinum, we generally are very underweight resources, and particularly so in the single commodity plays. But with Anglo's obviously, for all practical purposes, exiting platinum, we've opted to go into it. You can see there the share price has already recovered quite nicely. We bought for clients as well. A big part of our investment case is actually just around, more and more capacity has been coming offline, being mothballed, and a small shift in demand would actually catch the whole market flat-footed, and that's exactly what you can see in that top chart, where the platinum price rallied from about $950 to almost $1,500. It subsequently settled back, and platinum has done a similar story. The earnings are all over the ballpark. Obviously, COVID created some massive dislocations, but we believe that the more short-term to medium-term outlook has actually improved quite significantly, and it's a relatively low-risk platinum PGM play. Anglo American, we see now very much as a corporate action, almost a spec, being a sum of the parts. We do believe that once the De Beers deal is done and the Peabody transaction concluded, they will be left with assets that make them particularly attractive to BHP Billiton or BHP Group. So we are highly convinced that the Anglo-American will probably not exist 3 years from now. Richemont's been disappointing. It was really the darling you saw, in the beginning of 2025, really just took off, and obviously coming back to earth with a bit of a thud. This is the rand price, obviously, and the combination of a slightly firmer rand, but also maybe the market seeing a lot more trouble on the horizon for luxury goods, particularly given the impact of tariffs. So, this is one to keep an eye on the other leg. But we in the fund we're fairly opportunistic, and we don't currently hold any there. Coronation Fund Managers really very much like a Naspers, a geared market play. We bought them sort of in the 36 Rand, 38 Rand mark, also for clients with appetite where they didn't have excessive financial exposure. So, the move to 43 doesn't sound spectacular. We got a very nice special dividend after the tax ruling, and also this business pretty much pays out everything it earns. So we believe realistically you're looking at a dividend yield of approaching 10%. But it's really the geared market, so market goes up 10%, revenue goes up 10%, the costs don't go up 10%, but there's almost a multiplier effect on earnings. And that's a very similar story to 91. Obviously 91 a lot bigger, more international. Coronation more local, more geared to the local market. Old Mutual, since this chart was produced, came out with results that really pleased the market, bumped up 6%. We see this as the sum of the parts. We do believe the insurance business is getting a bit of energy again, but we like the sum of the parts. So if you take everything together, the insurance business, obviously short term, the financial, the bank, etc., we think that it's worth probably 30-40% more than the current share price. Mondi, very new acquisition, mainly in the fund. I apologize, this is the pound price on the that we're giving you here. The rand price around 250, come off from around 350. We believe that the cycle is looking as though it's turning better in the packaging world. They've done some really hard work at building capacity, low cost capacity as well. We believe that this is going to be a good performer, and not that we buy for rand hedge, but it obviously gives you strong international earnings. Quilter, very much a new acquisition, mainly in the fund, almost exclusively in the fund, really a beneficiary of pension reform. We're still getting our arms around the business, but we believe that they'll do very, very nicely, and that the AUM on the assets on their platform will be a strong driver of earnings over the coming years. Then African Rainbow Capital, it was delisted at 9.75 Rand. We elected to retain a holding in that. The fund held around 7 or 8% at the time. We sold those down, accepted some in the offer, but we retained the 3% in the fund, and we've also continued to hold for clients. Obviously, that doesn't reflect in client portfolio, so we need to do a manual adjustment on that. We didn't take the decision to go into the unlisted lightly. It was really driven by the fact that we believe that they've got some really exciting assets, particularly Time Group and Time Global. So liquidity, we believe, will take a while, but we believe the wait will be, or the lack of liquidity and the wait will be worth it. So looking at it all, winners and losers, starting maybe with the detractors. Aspen, as we indicated, probably coming too hard. Just disappointed once too often. But we'll wait patiently to see what the results look like and better understand, the realistic outlook. CUP has been disappointing, but we think that that's a short-term phenomenon. City Lodge has been disappointing because it's really just going nowhere. And then, of course, the diversified miners have been disappointing, but we're very underweight, so it hasn't really cost anything. On the other hand, the winners, Naspers and Prosus, obviously have really powered ahead. If you look over a longer term, banks and the likes of Argent and Raynet have done very well. More recently, Ethos and the Brait and the Value Unlock is driving. And obviously, from when we got into African Rainbow to where we exited, we saw good gains, as we have in Coronation in this discoveries that were sold. So that's really it. We thank you very much for your time and your attention. We, as always, encourage feedback. If there's anything that you want to ask or any commentary you would like to make, we encourage you to do so. We've gone through these slides very quickly, but we do trust that the message was coherent, and we thank you again for your continued support.